Good morning. You are watching live daily market outlook for Tuesday, 28th of February 2012. A slight improvement is seen in the markets during the Asian session and the early Europe hours after most of the majors reversed. There are strong recent gains. The euro dipped down to 133.65 yesterday. Sterling was contained at 158 and dollar yen at 80.00 and currently recovering. Dollar Swiss bounced higher to 90.00, our first strong barrier, and currently holding below halfway down towards a recent low at 89.29. It seems that risk appetite is back in play. However, some gains some levels need to be regained in order to confirm. Oil is also higher from the Asian after hitting a fresh high on last Friday at 109.92 and dipping as low as 107.26 in the late hours of yesterday's session. Currently at 108.59, recovering of yesterday's spike low, while the gold is also bouncing higher after testing strong support at 1763 with brief break lower down to 1761.50, currently at 1775. The Asian shares were also higher during the overnight session, as most of the markets are awaiting the second liquidity injection from the European Central Bank to gauge risk appetite that has been somewhat dented by worries over high oil prices. Looking to the ECB longer-term refinancing operation due on Wednesday, analysts were focusing on the size of the gross allotment as well as net new liquidity. A poll showed 30 euro money market traders expected the ECB to allot 500 billion euros with the forecasts ranging from 200 billion to 750 billion euros. The ECB's first liquidity injection into the system in late December helped stabilize markets by removing concerns about liquidity crunch in Europe. Also important was yesterday's approval of the help for Greece, as German Chancellor Angela Merkel scrapped through the parliamentary vote endorsing a second bailout for Greece on Monday, but faced a growing backbench revolt against pouring in more money in support of the Eurozone. The comfortable victory of 496 against 90 votes with 5 abstentions was inflated by center-left opposition support, but only 304 of Merkel's 330 center-right coalition lawmakers backed the motion. The analyst said the outcome could weaken her politically and make it harder for her to agree to strengthen Europe's financial defenses just when international pressure on Germany is rising. From the other side, Germany's German data showed, released today, showed the consumer climate rising to the fresh high and hitting 6.0 this morning versus the 5.9 of the previous month and the 6.1 forecasted for today. Now, since we are in the calendar, the German preliminary CPI due to be released during the day for all regions, while it currently is due to be released the Swiss employment level that was forecasted at 4.3 million versus 4.03 million versus 4.05 million of the previous month release. From UK at 11 o'clock GMT CBI realized the sales, a slight improvement, minus 17 is today's forecast compared to minus 22. That would be all for today from the Europe. Across the ocean, US durable goods orders monthly release due at 13:30 GMT. Decrease by 0.8% is forecasted for today compared to the healthy 3% of the previous month. Core durable goods orders are expected to stay unchanged, while the previous month release was 2.2% from US at 1400 GMT. composite 20 HPI index yearly release minus 3.6% is today's forecast versus minus 3.7% of the previous month release. U.S. consumer confidence is due at 1500 GMT. An improvement is expected to 63.1 compared to 61.1 previous month release. Also to mention that yesterday's data showed the U.S. home resales rising to near two-year high in January. That is now currently boosting optimism that the housing market might be recovering. From the markets, we're going to take a look in the technicals and see the latest movements and the expectations for the majors and the commodities. As we can see, euro is in up move of yesterday's low at 133.65, hit in the early hours of U.S. session yesterday, just ahead of 133.56 last Friday's low, and 133.41 low of high of last Thursday. A strong support zone that actually contained the dip, as well as 20 days moving average shown here on the 4-hour chart that contained the dip, and the current rally is now underway. Clearance of next level at 134.55 was seen so far, with break above 134.63, yesterday's intraday high, expected to confirm and refocus upper levels at 134.85, the recent high posted on Friday, and then to expose 135 and 135.47, our static resistance target high of 2nd of December 2011. The pair is currently hovering around 50% retracement of the broader down move from 142.46 to 126.22, with the current congestion seen corrective on the daily chart, as studies are still in the positive tone, yet no signals of reversal. On the upside, 135, 135.47 remain the targets. On the downside, the loss of today's low at 133.65 and the significant support at 133.56.40 would delay immediate bulls in favor of stronger reversal, with the key support zone at 132.00 previous congestion, and the higher platform of 22nd of February. Loss of this one would definitely put the bears aside. However, we are still a bit far from this, and currently the current structure shows that market is still, the pair is still more turned to the upside, as the 4-hour studies are more or less pointing higher and holding above their midlines. Sterling is in recovery mode of yesterday's low at 158.09, when the recent pullback of again 200 days moving average that capped the upside hit 158.00 was contained at this level, with the fresh strength now underway. 158.71 is current level, attempting through 158.74, yesterday's intraday high, above which to refocus our levels at 159, and possible extension higher. Break above 200 days moving average is a must for the pair to resume higher, while failure to clear this level, as well as 159.26, the previous high of 8th of February 2012. This is required to end this range trading of beginning of February, that is limited on the upside at 159, on the downside at strong support at 156.50 platform. To break above the range and resume the broader uptrend of mid-January 155.33 low, to open next levels at 160 and 160.90 on a break. Failure, as I said, to clear again 200 days moving average would signal further the pair still entrenched within this range, and further sideways movement shows on the daily chart. On the hourly, the structure is more positive, as currently the Indicators are breaking above their midlines with the RSI holding above its moving average and pointing higher, keeping the focus on the upside. On the downside, immediate support is at 158.00 zone, where the recent losses were contained. However, holding above more important 157.70 zone, its previous congestion of November, December 2011. A loss of this level would allow for further reversal. Key support on the short term remains at 156.50. An only break here would significantly damage the current positive structure of the pair. Dollar yen is back to strength after recovery, or after reversal of yesterday's high at 181.65. This is fresh 9-month high, dipped down as low as 80.00 at the figure support, where the dips were so far contained. This morning's price action shows the break above initial resistance at 80.61 yesterday, and overnight high. Currently the pair is at 80.74, looking for test for regain of 81.00, above which is to resume to avert immediate downside risk and resume towards 81.65, which is our immediate target on the upside. Yesterday's high to resume gains towards 82 and 82.60 on a break. The pair, as we can see, is 82.20, pardon. The pair is now well above the recent range from July 2011 until now, and that gives a good signal for a further extension higher. However, to make more significant this bounce, to make more significant, we need to see the regain of minimum 85 zone. This is the high of 3rd of April 2011 to signal the bottom at 75.56, which is the record low of dollar yen. Immediate supports are at 80.00 and 79.50, and for now are expected to hold the downside intact, as the broader picture daily studies are firmly bullish, although overextended studies still see potential for a corrective reversal. Only loss of 78.50, 78.20 would harm the current strong bullish structure and signal possible reversal and return into the broader range trading. The dollar Swiss seems the pair is losing traction again after a bounce of last Friday's low at 89.29, hit the 90.00 initial resistance. 90.09 was the high seen so far, ahead of fresh weakness. At the early hours of the Europe, there was still potential for a further recovery and further bounce higher. Of course, that would be seen, as many analysts agree, as a selling opportunity, as the pair remains in the strong downtrend of 95.93 beginning of January high, and a lower top at 93.00, and keeping the focus to the downside so far, with possible extension up to 90.70, 91.00 strong resistance zone, according to analysts, seen as a good selling opportunity and nothing else. For now, the upside remains intact at 90.00, with the pair currently attempting at the initial support at 89.45, ahead of our low of last Friday at 89.29. That will open way for further extension lower at and 89.00 round figure support to come next, ahead of a possible extension down towards 88.70 and 87.70 on a break. The crude oil seems to be regaining ground after reversal of latest fresh high at 109.92, just ahead of psychological strong barrier at $110 per barrel. dipped down to as low as 107.26. This was seen in late hours of yesterday's session. However, quick recovery followed during the Asian session, and the pair is currently attempting at hourly 55 days moving average at 108.64, break of which required to refocus the next barrier at 109.34, yesterday's intraday high, yesterday's intraday high, and above which to refocus our recent high at 109.92. The broader picture remains firmly bullish, as the pair is still within the firm channel of 895.83 low of 7th of February, and focus remains on the upside, as the main driver of crude oil is still the current dispute between Iran and the West regarding the nuclear weapons, and also, of course, the possibility of disruption of the supply of oil through the Hormuz, as well as sanctions imposed to Iran that most of European countries have already imposed, and this Iran on its own stopped supplying France and UK, as well as Asian countries that are the main consumers of Iran oil, especially China and India, that are reducing the imports of Iranian oil, keep the pressure on the upside, towards the upside on the oil price, and the possible extension if we see the break above $110. May's high at 114.80 would be the likely scenario in the short term. The yellow metal is currently still in the corrective mode after hitting fresh high at after hitting a fresh high at 1787 last Thursday. The dips hit 1761.50, just dented our next support at 1763. However, keeping still the overall positive structure of 1705 higher platform is in play, as the pair quickly regained gold price quickly regained the levels above 1770, currently at 1776, with next mild support at 1783, ahead of a key barrier at 1787. On the wider picture, our immediate target is 1795 and 1802 highs of beginning of November 2011, as the uptrend remains intact for now, with the dips, recent dips being contained above 1755, the main bull trend line, and the price action remains within the channel of wider picture rally of 1522 low of 29th of December 2012 on 2011. On the wider picture, only loss of 1705 higher platform of mid-February would significantly harm the current bullish structure and allow for further weakness. For now, the pair remains in the strong uptrend, as the break of the main bear trend line drawn of 1920 record high and connecting highs at 1802 and 1703 is taken out, and the focus remains at the upside. Thank you.